Welcome to Hidden Currency. This channel exists for those who have lived long enough to understand that the most important economic truths are rarely spoken loudly. If you value calm analysis over noise and long-term positioning over short-term excitement, consider subscribing. Not for entertainment, but for clarity in an uncertain cycle. And before we begin, from which part of the world are you watching this briefing? For more than a decade, global capital followed a clear and almost unquestioned hierarchy. At the top sat technology, clean, scalable, and seemingly unstoppable. Companies built on code, data, and intellectual property were treated as the safest path to growth. Beneath them sat energy, industrials, and commodities. At the very bottom, nearly forgotten, were monetary metals like silver, viewed as relics of an older financial world. This hierarchy was not accidental. It was shaped by years of low interest rates, stable supply chains, and confidence in global systems. Investors believed innovation could replace scarcity. They believed efficiency could overcome limits, and they believed physical assets were inefficient compared to digital ones. Then, quietly, that belief system fractured. On January 7th, 2026, during the Asian trading session, a valuation crossover occurred that challenged the foundation of modern portfolio theory. The total estimated global market value of silver briefly exceeded the market capitalization of NVIDIA, one of the most influential technology companies in the world. NVIDIA was not just another stock. It represented artificial intelligence, automation, and the future of computation. It powered data centers, defense systems, and emerging technologies that governments and institutions relied upon. Silver, by contrast, had no public relations team. It issued no earnings calls. It promised no innovation roadmap. And yet, measured purely as a store of value, it overtook one of the most celebrated symbols of the digital economy. This was not driven by excitement or speculation. There was no retail frenzy, no viral headlines, no sudden surge in media coverage. Most investors did not even notice it happening. That silence is precisely what made the event important. Historically, major capital rotations begin quietly. They start not with crowds, but with institutions. In financial history, valuation crossovers often signal deeper changes in trust. When one asset surpasses another, it reflects not only price movement, but a reassessment of risk. In this case, investors were not buying silver because they expected rapid growth. They were buying it because they were questioning assumptions they had relied on for years. Technology assets depend on complex systems. They require stable energy supplies, functioning supply chains, geopolitical cooperation, and confidence in financial infrastructure. Silver requires none of these. It exists independently of networks, software updates, or policy decisions. It is not efficient, but it is resilient. This distinction became increasingly relevant as global conditions changed. Supply chains grew fragile. Energy costs became unpredictable. Geopolitical tensions increased. Debt levels reached historic highs. In such an environment, efficiency loses value relative to durability. For years, financial advisors told clients that physical assets were unnecessary in a modern economy. They argued that innovation had reduced the need for hard money. But innovation does not eliminate risk. It redistributes it. And in times of stress, redistributed risk has a way of concentrating suddenly. The silver market reflected this shift. Industrial demand remained strong, driven by electronics, solar energy, and manufacturing. At the same time, investment demand quietly increased, particularly among institutional buyers. These buyers were not speculating on short-term price movement. They were hedging against systemic uncertainty. For decades, capital flowed in one direction only, from factories to algorithms, from metals to microchips, from what could be touched to what could only be promised. But quietly, without headlines, without applause, that direction reversed. While most investors were still debating interest rates, while portfolios remained anchored to technology narratives, a single ancient asset crossed a line Wall Street believed could never be crossed. Silver, a metal long dismissed as obsolete, momentarily surpassed one of the most powerful corporations of the digital age. This was not a price spike. This was not speculation. This was a signal that capital was no longer chasing growth. It was seeking certainty. And if this rotation continues, what happens to technology valuations? What happens to paper wealth? What happens to portfolios built on assumptions that no longer hold? Because the most dangerous market shifts are not announced. They are recognized too late. And by the time the majority understands what this moment truly represents, the repricing is already complete. What made this moment especially striking was silver's price. At roughly $80 per ounce, it did not appear extreme by modern standards. To many observers, it even looked expensive compared to past prices. But that perception was shaped by nominal figures, not real value. When adjusted for decades of currency debasement, silver remained far below its historical purchasing power. In simple terms, the price had not caught up with reality. This created a contradiction. One of the most undervalued assets was simultaneously becoming one of the most valuable. That contradiction forced sophisticated investors to pay attention. The crossover with NVIDIA did not mean silver had replaced technology. It meant capital was beginning to rebalance. Investors were no longer willing to assume that growth alone justified valuation. They were asking harder questions about permanence, reliability, and exposure to systemic risk. This was the first visible crack in a structure that had stood unchallenged for more than a decade. And like most structural failures, it did not announce itself loudly. It simply shifted weight. From promises to possession, from complexity to simplicity, from confidence in systems to confidence in substance. After the valuation crossover, serious investors did not ask whether silver would stay above technology companies. That was never the real question. Instead, they asked something far more important: why capital had begun to move at all. For nearly 15 years, growth had been trusted more than stability. Investors accepted low or even negative cash flow as long as future expansion looked strong. Valuations were justified by narratives, network effects, artificial intelligence, digital dominance. Risk was tolerated because systems appeared stable and predictable. That environment no longer existed. By late 2025, several pressures began to overlap. Global debt levels were no longer abstract numbers. Governments carried obligations that could not be repaid without currency expansion. Central banks faced a dilemma: tighten policy and risk collapse, or loosen policy and weaken money further. Neither option inspired confidence. At the same time, supply chains that once seemed efficient revealed their fragility. A single disruption, energy shortages, shipping delays, political conflict, could ripple across industries. Technology companies, despite their innovation, were deeply exposed to these vulnerabilities. Data centers required constant power. Semiconductor manufacturing depended on rare materials, global logistics, and political cooperation. Investors began to realize that technological growth was not independent of the physical world. It was built on it. Silver sat at the center of this realization. It was not just a monetary metal, it was also an industrial one. It played a critical role in electronics, solar panels, medical equipment, and advanced manufacturing. Unlike software, it could not be replicated or optimized away. Each ounce required extraction, energy, and time. As demand increased, supply did not respond quickly. Most silver production came as a byproduct of other mining operations. It was not mined because prices were high. It was mined because other metals were profitable. This created a structural constraint that few investors had previously considered. In contrast, technology valuations assumed flexibility. If demand increased, capacity would expand. If margins compressed, innovation would restore them. These assumptions worked well in stable environments. Under stress, they became fragile. Institutional investors, particularly long-term capital managers, began adjusting quietly. They did not announce a rejection of technology. Instead, they reduced exposure at the margin. They diversified into assets that did not depend on continuous growth or stable policy. Silver benefited from this shift, not because it was exciting, but because it was boring. It had no quarterly earnings pressure. It had no management risk. It did not rely on consumer confidence or credit expansion. Its value came from scarcity and function. This distinction mattered. In previous cycles, investors believed diversification meant holding different types of paper assets: stocks, bonds, real estate, private equity. But when systemic risk increases, correlation rises. Assets that appear diversified can fail together. Physical assets behave differently. They do not default. They do not dilute. They do not depend on counterparties honoring contracts. In an environment where trust becomes a variable, this independence carries weight. Another factor contributed to the shift: time horizon. Younger investors often focus on growth because they expect time to absorb volatility. Institutions managing pensions, endowments, and sovereign wealth do not have that luxury. They must preserve purchasing power across generations. For these investors, the question was simple. If currencies continue to weaken, and if financial systems become more complex and fragile, what asset remains reliable without intervention? The answer did not change with technology. It remained physical value. This did not mean silver was immune to volatility. Prices could fluctuate. Markets could overshoot. But volatility was not the same as dependency. Silver's value did not require belief. It required existence. As this logic spread, the rotation gained momentum. It did not show up immediately in headlines or retail trading apps. It appeared in allocation models, inventory movements, and long-term contracts. These were not emotional decisions. They were defensive ones. Capital was not fleeing innovation. It was hedging against overconfidence. The important insight was not that silver became more valuable. It was that growth narratives became less trusted. When trust weakens, investors seek assets that do not ask for faith. By early 2026, this mindset had taken root among those who moved first. And once capital begins to question its assumptions, it rarely stops at one adjustment. By the time capital began rotating, the emotional arguments had already lost influence. What drove the next phase was not fear, belief, or ideology. It was mathematics. Simple arithmetic that had been ignored for decades finally forced itself back into relevance. For years, silver's price was judged in nominal terms. Investors looked at charts, compared recent highs to recent lows, and assumed the market was behaving normally. A move from $20 to $80 per ounce appeared dramatic. To many, it felt excessive. But this interpretation relied on a flawed reference point. The measuring stick itself had changed. Currencies had been diluted slowly, consistently, and legally. Over decades, purchasing power eroded, not through collapse, but through policy. This erosion was subtle enough to be tolerated, but significant enough to distort all long-term comparisons. When investors compared silver prices across time without adjusting for currency debasement, they were not comparing value. They were comparing illusions. When corrected for purchasing power, the picture changed completely. Silver's previous peak occurred in 1980, when it reached roughly $50 per ounce. At the time, that price carried real weight. It could purchase tangible goods, homes, vehicles, labor. Decades later, that same $50 could no longer do so. The dollar had lost most of its strength. When adjusted using official inflation data, $50 from 1980 equated to well over $150 in the mid-2020s. Independent inflation models suggested an even higher figure. By any reasonable calculation, silver at $80 was not expensive. It was undervalued. This realization mattered because markets do not remain mispriced indefinitely. They can ignore fundamentals for years, even decades. But when pressure builds, correction becomes unavoidable. Not gradual, not polite, structural. What made silver unique was the duration of its suppression. Other assets had already repriced. Real estate adjusted upward. Equities expanded far beyond historical norms. Even gold, silver's traditional counterpart, moved significantly higher. Silver alone lagged behind, disconnected from both monetary reality and industrial demand. This created tension. Industrial users required silver regardless of price. Electronics, energy infrastructure, and manufacturing could not function without it. Demand was inelastic. At the same time, investment demand began to rise quietly, driven by institutions reassessing long-term risk. Supply did not respond. Unlike most commodities, silver production could not scale easily. The majority of global silver supply came as a byproduct of mining other metals. Even higher prices could not quickly increase output. New mines required years of development, regulatory approval, and capital investment. The system was rigid. When rigid supply meets rising demand, the outcome is not balance. It is pressure. That pressure began to show in inventories, particularly in exchange-monitored stockpiles. On the surface, markets appeared functional, contracts traded, prices updated. But beneath that surface, available physical metal thinned. The futures market, especially at institutions like COMEX, operated on leverage. For every ounce of physical silver, many claims existed. This structure relied on the assumption that most participants would settle in cash, not demand delivery. That assumption held until it didn't. As confidence in paper assets weakened, more participants chose physical settlement. They were not speculating, they were securing supply. Each delivery request reduced available inventory further. The system could tolerate moderate demand. It could not tolerate sustained conversion. This created a quiet imbalance. Official reports still showed orderly markets, but the margin for error narrowed. A single disruption, logistical, political, or financial, could trigger a delivery failure. Such an event would not merely affect silver prices, it would challenge confidence in the structure of paper commodities themselves. Markets are built on trust. Futures contracts work because participants believe obligations will be honored. When that belief weakens, price discovery accelerates. Not gradually, but suddenly. This is why analysts began discussing higher price targets not as speculation, but as correction. Numbers like $200 per ounce were not forecasts. They were reference points derived from purchasing power, scarcity, and structural imbalance. In this framework, silver's movement was not extraordinary. Its previous stagnation was. The market was not pushing silver upward. It was removing the weight that had held it down. Once mathematics replaces narrative, sentiment becomes irrelevant. Prices move because they must. And when that shift begins, it rarely stops at the first adjustment. By early 2026, the arithmetic was no longer theoretical. It was embedded in contracts, inventories, and institutional decisions. The only remaining question was timing. By the time the mathematics became clear, the market had already entered its most dangerous phase. This phase was not defined by price movement, but by complacency. Most investors still believed they had time. They assumed adjustments would be slow, orderly, and well telegraphed. History suggested otherwise. Major financial shifts rarely unfold in a straight line. They move quietly for long periods, then suddenly. The silver market, by early 2026, showed all the characteristics of a system under strain. Not collapse, but stress. And stress, when ignored, compounds. The core issue was not price. It was structure. Modern financial markets are built on layers of promises. Futures contracts promise delivery. Exchange-traded products promise exposure. Custodial accounts promise access. Each layer assumes the layer beneath it remains functional. When confidence is high, this structure works. When confidence weakens, it becomes fragile. Silver exposed this fragility more clearly than most assets. Its physical nature made abstraction difficult. An ounce either existed or it did not. There was no substitute, no digital equivalent, no workaround. When physical demand increased, paper claims were tested. For years, the system relied on the assumption that most participants preferred cash settlement. That assumption was rational in a stable environment. But as trust in currencies declined, behavior changed. Participants began to prefer possession over promises. This shift altered risk in a fundamental way. If delivery demand exceeded available supply, the response would not be subtle. It would force repricing, not because of speculation, but because scarcity would finally be reflected in price. Such repricing would not be limited to silver. It would send a signal across all markets dependent on leverage and confidence. This is why the rotation mattered beyond one asset class. When capital moves from growth narratives to hard assets, it reveals a deeper concern. Investors are no longer optimizing for return. They are prioritizing survival of purchasing power. This change in objective reshapes markets. Technology companies, while still innovative, become valued differently. Their dependence on energy, materials, regulation, and stability becomes more visible. High valuations built on long-duration assumptions face pressure when discount rates rise and confidence falls. Young entrepreneurs and business leaders needed to understand this context. The lesson was not to abandon innovation or growth. It was to recognize that cycles exist and that ignoring them carries cost. Many portfolios were constructed during an unusual period of stability. Low rates, abundant liquidity, and expanding balance sheets created an environment where risk felt distant. That environment had changed. Adjustments made slowly could still be effective. Adjustments delayed could become forced. Silver's rise was not a call to speculation. It was a signal of imbalance correction. It reflected stress in currencies, strain in supply chains, and skepticism toward long-term promises. These forces did not disappear because prices paused or markets rallied elsewhere. They accumulated. For decision makers, the warning was clear. Systems built on leverage require confidence. Confidence is not permanent. When it erodes, assets tied to physical reality behave differently from those tied to expectations. This did not guarantee a single outcome. Markets could stabilize, policies could adjust, innovation could mitigate risk. But ignoring structural signals reduced optionality. Preparation preserved it. The rotation of capital was not complete. It had only begun. Early movers acted quietly, not because they knew the future, but because they respected uncertainty. They did not attempt to predict exact prices or timelines. They reduced exposure to assumptions that required everything to go right. This mindset mattered more than any specific asset choice. Silver, in this context, served as a diagnostic tool. It revealed stress points. It highlighted where trust was thinning. It showed where abstraction met reality. For those willing to observe calmly, the message was not dramatic. It was practical. Markets were changing. Risk was being redefined. And portfolios built for the last decade were not guaranteed to function in the next. The warning was not urgent because of silver's price. It was urgent because of what that price represented. Those who recognized this early did not panic. They adjusted. And in cycles like this, adjustment, not prediction, determines who remains standing when repricing is complete.